Welcome to the Lending Forward podcast, brought to you by Atlantic Bay Mortgage Group. This is your home for real discussions about the mortgage and housing industry. Our hosts are here bringing you firsthand accounts from people at the heart of the business. And we're chatting with professionals from all corners of the industry as they help cultivate transparency around the future of the industry we love. Together, we are lending forward all we know to you. Thanks for joining us for today's episode. Let's dive in.
All right, we are back with another episode of Lending Forward and continuing on the conversation with all of the changes in DC. I am joined by Mike Silver. Mike is a partner at Husch Blackwell, specializing in regulatory compliance and consumer finance law. He has over a decade at the CFPB and played a key role in shaping a lot of the regulations that we see today. So Mike, welcome to Lending Forward.
Yeah, thank you, Hannah. It's really great to be here.
Yeah, we, it's been a hot start to the year. So before we dig into all the CFPB changes and everything, tell us a little bit of background on you, especially how did you get into mortgage regulation?
Yeah, so it's been an interesting path for me to mortgage. First off, for those of you who might look my bio up, there are two Michael Silvers at Husch Blackwell. It's like the craziest coincidence. The other one is in St. Louis, and he's a private wealth attorney. So we have like nothing in common professionally other than our name. So I go by Mike G. Silver. It's like a rebrand. So I've been at Husch Blackwell for just over the last year. And previously I was at the CFPB, as Hannah, you mentioned, for over 12 years. So I started there about 7 weeks after the agency was up and running. But my journey to mortgage started before that. It was a little circuitous, but basically out of law school in 2004, I started at a DC firm called Shaw Pittman, just a typical big law firm. I went through a fall interviewing process and started out as an associate. I wanted to do litigation, but they didn't have a spot. So they convinced me to do commercial real estate. So I spent 7 years as a commercial real estate attorney. I learned how to draft commercial leases, retail leases, shopping mall, purchase and sale agreements, financing, et cetera, et cetera. I looked at more survey documents and title commitment documents than you can imagine. But again, it was all on the commercial side with some limited exception. And, I came to DC when I was 22, and I always had an interest in government and politics. And at some point, I just decided, this path of commercial real estate was really not for me. And it just happened to coincide with the financial crisis, 2008. And, at that point, I was starting to think about a pivot. And the CFPB, it was really lucky that I was looking when the CFPB was created and they needed to hire a bunch of people. And I was able to persuade them that, a commercial mortgage is not all that different from a residential mortgage. And I know about real estate and, the rest, it's just detail. And, they bought it, and I'm grateful that they did.
Let's dig into it a little bit. I mean, it feels like, things are shifting every day. I guess my first question is, is the agency actually functioning right now? And if so, who's calling the shots?
We really don't know. And I say that not as just a casual outside observer. That's literally a legal question that is being litigated as we speak in the federal district court in DC. There was a hearing yesterday, and just to step back on kind of where we are in the process, and it's like impossible to distill even to, the rest of a 30-minute podcast, but just, I guess, a quick TikTok on what's happened. So under the Celia Law Supreme Court decision from 2020, which related to the CFPB director can be fired for any reason or no reason by the president. That's different than the original structure in the Dodd-Frank Act, which protected the CFPB director from being fired unless there was good cause. because of that, Rohit Chopra, who was formerly the CFPB director, was fired on, I believe it was February 1st. And it was a little surprising. People expected him to be fired on Inauguration Day. And there was about a 2-week period where he was doing, some media interviews, basically saying, look, I haven't been fired yet, and being able to tout and discuss, his legacy and some of the accomplishments under his leadership. Well, he was fired on February 1st. Initially, Treasury Secretary Scott Bessent, who had just been confirmed to that post, was named the acting CFPB director. And this is something similar to what happened in 2018 or late 2017 when former director Richard Cordray resigned as CFPB director, and the then head of the Office of Management and Budget, Mick Mulvaney, was appointed to be the acting director, essentially as a moonlighting part-time job. So it looked like that was going to be the playbook. It would be a repeat of what happened in 2017. And I think most of the prognosticators were expecting the rest of the process to play out similarly in terms of the agency might take a pause, they might drop a couple of enforcement actions, go in a different direction on some of the final rules that came out last year, but more or less do a pivot, go in a more conservative direction, tighten things up a bit, and move on. Mm-hmm. That is not what has happened. It has been an upheaval of pretty epic proportions.
With all of the changes and all of the uncertainty, how should the industry be responding right now?
So you had Pete Mills and Justin Wiseman from MBA on a couple of weeks ago, and I thought what Justin said was really spot on. The gist of it was, don't follow the noise on Twitter, kind of the day-to-day machinations of what's happening. Just kind of step back, and some stuff is just going to take some time to settle out. And I think that's exactly right. And I follow things that are publicly reported, and I'm in touch with many people who are still inside the agency, and so I get information in different ways. And it's a very sad situation, just for me personally, just to watch the agency that I spent 12 years trying to help build and grow is potentially at risk, and then seeing many great, talented lawyers, economists, and other people who are having to now quickly look for a new job and worrying about paying their mortgage and again, I say all that like completely, and we'll talk about my piece in the Open Banker, like with the knowledge that like the CFPB has overstepped and has not always been popular, particularly among industry stakeholders, and there is a vigorous debate to be had about the policies coming out of the Bureau, their approach to regulation, their approach to enforcement. But what seems to be happening now just feels different. It's more existential.
Well, let's talk about the article that you wrote in Open Banker. You mentioned, we shouldn't scrap the CFPB. We should refresh it. Do you mind kind of expanding on what you meant by that? What changes do you think would make it work better?
No, thanks for mentioning the article. And it's really a two-part thesis. And the first part was something that I wrote about a little while ago. I believe it was last May or June in the American Banker publication, right after the Supreme Court case regarding the CFPB's funding was decided. For those of you who aren't aware, it was the second time that the CFPB was before the Supreme Court. There was a challenge to its constitutionality. This case related to a payday lending rule regulation that was finalized in 2017. I had actually worked on that rule while I was there, went all the way through the courts up to the Supreme Court, and it turned into a constitutional challenge about the CFPB's funding mechanism. And the CFPB was found to be constitutional. It was a little bit surprising. It was a 7-2 pretty lopsided decision. Clarence Thomas, very conservative justice, wrote the opinion. So at the time, my prediction, along with many, was that the existential threat has abated. The CFPB survived this constitutional challenge, and therefore going forward, like the agency legitimacy had been established, and what needed to happen was the agency needed to grow up. That was the title of my American Banker article. And the thesis is that, in my view, a lot of the CFPB's issues, problems, inconsistency in its policymaking, the vacillation between administrations, where it feels like a whipsaw, has to do with the age and the immaturity of the agency. The fact that it's only 12 and a half years old. And I made the analogy to my older daughter, who's almost 13, and how, as great as she is and as smart as she is, she's still only 12 and a half, and she has to grow up. And so does the CFPB. And to be more concrete, it's the notion that the agency hasn't been around long enough to really develop strong, durable internal controls and processes and guardrails for policymaking and for legal interpretation. And that's very different from other federal agencies like the Customs Service, which has been around since the 1780s or the 1790s, or the FTC, Federal Trade Commission, which has been around since the 1930s. It's 12 years old, and it simply is just an immature organization. And because of that, the political leadership, regardless of which administration is in charge, tends to exercise an undue influence over everything, not just the policies themselves, but just how the organization is managed and shaped day to day. And that's why you see things like Mick Mulvaney trying to, some of you may remember this, wanting to rename the CFPB to the BCFP, and some of the other reorganizations where they're constantly shuffling offices around and changing things. You also see this with innovation, their approach to innovation policies, which have gone in radically different directions depending on administration. So that's part one of the thesis. But part two, which I really developed more in the open banker piece, is, again, going back to Celia Law. That's the first Supreme Court decision that they faced in 2020, which I mentioned earlier. In my view, that totally changed the incentive structure for agency leadership, in the sense that previously, if it wasn't, if the director was protected from being fired for any reason by the president, they were not necessarily viewing their tenure as a 4-year political cycle. Rich Cordray, for example, stayed through the end of 2017. He was there for 1 year into the Trump administration. We finalized that payday rule in October of 2017, 9 months into the Trump administration. And so it was an interesting dynamic where, the presidential administration maybe didn't necessarily agree with the policy choice, but he still decided to release that final rule. It's not like that now. There's basically lockstep between the priorities of the presidential administration and the CFPB leadership. And so I do think it has served to politicize the agency a lot more. And again, I know people, some people have the view, and it's not totally unfounded, that the agency has been politicized from the beginning. But I do think that Celia Law kind of made the problem worse. It changed the incentives, like I said, so that someone like Director Chopra basically viewed the job as, let's try to accomplish as much as we can, as quickly as we can, using any means necessary within the next 4 years, regardless of long-term consequences, both for industry as well as for the agency itself. And the durability and the institutional integrity of the agency.
What do you think the biggest policy priorities will be moving forward?
So it's hard to say I'm here to offer some predictions. Simply because again, not to beat a dead horse, but what's been happening the last month it's really been divorced from any discussion of policy. It's just been about the agency itself and the institution. And even, the dismissal of a lot of the enforcement actions that have been happening, they haven't been providing reasoning or justification. They've just been going to court and filing notices and occasionally tweeting about it. So we don't even really have a sense of where Russ Vogt is on, the why. There's a lot of what, but there's not a lot of why. And McKernan, he offered a few glimmers or hints of his policy priorities during the confirmation hearing. One that was interesting was he did kind of go out of his way to praise Chopra for Chopra's focus on consumer data privacy issues and issues around data brokers and sale of data to bad actors. And that could suggest that he would be open to finalizing the Fair Credit Reporting Act data broker rule, which incidentally, the comment period for that rule was supposed to expire yesterday, but they went ahead and they extended it for a month. So that could be a sign that maybe they are interested in finalizing something. I doubt it would be as broad and sweeping as what was proposed, but that did seem like something where maybe there is unanimity across the aisle in terms of a policy issue. I know MBA has talked a lot about, they talked on the recent podcast about RESPA at 50. Like, I'm all for rethinking RESPA and just really more broadly, rebooting the innovation function of the Bureau and just trying to take a more active approach towards grappling with the fact that a lot of the consumer credit laws that you all have to comply with day to day are 50 or 55 years old, and they are showing their age. In some ways, they're obsolete. As Justin said on the podcast a couple of weeks ago, RESPA was written at the time when there were no, we didn't have internet-based co-advertising arrangements. Everything happened in person and on paper. And there's just a chasm in terms of the kind of assumptions on which those laws and rules are based and like how things actually happen in practice now. And when I was at the CFPB and now in private practice, I get so many questions on, well, how does this type of B2B business arrangement involving technology where you're linking this party to this party, settlement service providers, how do you comply with Section 8 and marketing service agreements? And there really are no easy answers. And when I was at the Bureau, it was easy to kind of fall back on the mantra of, well, it depends on the facts and circumstances. But that's, that we have to do better in advising clients. But again, like trying to come up with some real modernized rules, whether it's RESPA or FCRA or other things to account for the fact that technology has changed so much and business arrangements have changed as well.
Yeah, I love to hear that. I love that you and Justin and Pete all are saying the same thing too about just modernizing and, getting the regulations to kind of mimic reality a little bit more. We appreciate you coming on so much. You are a wealth of knowledge, but I can't let you leave without asking you our signature question, which is, how do you plan on lending it forward in 2025?
No, I love this question. And I listened to a few of the recent podcasts to try to get a flavor of the vibe of how to answer it. So maybe I'm a little too over engineered rather than just winging it. But I think it's really just continuing, number one, continuing to voice this what I would call radical centrist vision of the CFPB, being a balanced agency that is really independent and truly, technocratic and not driven by politics and is both respectable and respected on both sides. That's not a political football. And that's not what I would also characterize as a Rorschach test. I think in the past, it's really if you remember the final scene of The Breakfast Club, I always go back to the final scene of The Breakfast Club because it's applicable to so many situations, not just the Judd Nelson fist bump. But, when Anthony Michael Hall is talking about the essay and about how the vice principal, he says, you asked us to write this essay, but you're going to see us the way that you want to see us. And I really think that's true of the CFPB. It has its champions, it has its critics, and there's often not much consensus between those two polar opposites. And I really wanted to get to a point where that's not the case, where it has legitimacy across all sides. And I think the steps that for that to happen, need to be kind of as I outlined in my essay. And again, like also just trying to help my colleagues navigate this really difficult situation and trying to provide insights on my job search recently and trying to help them. But then ultimately getting helping clients navigate regulatory ambiguities, labyrinths within state and federal regulations, just getting to a point where compliance is, something with, a person of my experience and expertise can help guide and shape and also with new product development and the like in the fintech space or mortgage companies and arrangements of that sort. So just trying to do good work with clients, trying to help my former colleagues as they navigate a tough situation, and then help, frankly, solve that housing counseling issue that I mentioned earlier.
That's awesome. Well, we so much appreciate you for coming on and lending it forward to us and our listeners. And I hope that you keep us updated on what you're hearing. I feel like you're right there in it. So we'll definitely lean on you for updates, Mike. But thank you so much.
Thank you. I really enjoyed speaking with you about all these issues.
Thanks again for tuning into today's episode of the Lending Forward podcast. Be sure to subscribe to our channel, follow us on Instagram @LendingForward, on YouTube and LinkedIn. Catch us every other Thursday with a brand new episode, and go lend something forward today. Atlantic Bay Mortgage Group, LLC, NMLS number 72043, NMLSconsumeraccess.org is an equal opportunity lender and employer. Located at 600 Lynn Haven Parkway, Suite 100, Virginia Beach, Virginia 23452.